How to Manage Personal Finances book, Chapter 11, Bank Drive-Through Windows and Common Stock Returns. This is Ken Boyd. And just a note at the beginning here, I am posting a text version of this entire book on Substack, video versions on a YouTube playlist. You can email me here for my fifth book's publishing date in late 24, early 25. Wait, they closed the drive-through window. I had to deposit a check, so I drove by a Bank of America branch. I rarely, if ever, get client checks, and I haven't visited in over a year. So I waited in line while one person got 7 different rolls of coins and a second person tried to deposit a 5-year-old third-party check. Okay, I made up the part about the check, but I had to wait nearly 10 minutes. So what's the point here? I had expectations. The same is true of most investors' beliefs about the returns they earn on stock. 3 types of returns. Generally, there's 3 ways you can earn a return on stock. Price appreciation, the most obvious. You profit from selling a stock for more than the cost. Cash dividend. The company pays you a cash dividend, which is a share of company earnings. Stock dividend. You receive dividend in the form of additional stock rather than cash, and you can benefit from the price appreciation and/or the cash dividend on the additional shares. To profit from the stock market over time, you must do something completely counterintuitive. And that is when you sense danger, don't run, don't panic. The US stock market has been an effective tool for investors to generate profits for decades if you're willing to be patient and accept volatility. So notice how I added that disclaimer about patience and volatility. When it comes to investing, most people aren't willing to accept these 2 realities. You have to accept these realities. When I was in college, Dire Straits had a big hit with a song called Money for Nothing in the 80s. And investing in the stock market is not a money for nothing proposition. If you're willing to live with short-term risk and volatility, as we'll see in a minute, from year to year, the stock market can generate earnings over the long term. So how long is long term? Well, let's call it from 1928 until today. One tool to measure how the stock market has performed is the Standard & Poor's or S&P 500 index, which is an index of 500 frequently traded stocks in the U.S. markets. The S&P index includes many names you've heard of, so think about Microsoft, Procter & Gamble, Apple, recognizable names. The idea here is that the S&P 500 behaves in a way that reflects the market as a whole, and it's an indicator of where all stock prices are headed. So rising tide, they all go up. Rising tide, they all go down. As the writer points out, over 88 years, the S&P 500 went up 64 years, went down 24 years. The worst was a 43% plus loss in 1931 during the Great Depression. The best, over 52% in 1954. So the way that we look at how the index performs over time is Seeking Alpha provides a great list that shows the total returns from 1928 to 2015. Now, it's important to note here, total return assumes that the capital gains, if you sell something for a gain, and the dividends that you earn, cash dividends, are reinvested. That's important to remember. So the writer points out this is how the index did over those years. Now, that may strike you as terrifying or encouraging, and I get it. But rather than looking at year to year, let's consider the average return over time. So what does Investopedia say? The average annualized returns since the S&P 500 started in 1928, which is why we use that year, through December 31st of 23 is 9.9%. And since they included all 500 stocks in the index, which is 1957, through 12/31/23, the total return on average 10.26%. So both these numbers right around 10%. So what's the lesson here? Be a realist. Don't expect more than the S&P 500 average return over time. The ups and downs from one year to another may be very jarring, but stay focused on the average return over 10 years, 20 years, whatever your investment horizon is, saving for a house, saving for retirement, etc. Remember that past performance is no guarantee of future returns, and discuss the risk and returns with an investment advisor. So that's as far as we'll get for right now on Chapter 11. And you can find the entire book on Substack and on the YouTube playlist. Thanks for watching.